Digital asset regulation is no longer just a compliance question. It is becoming market infrastructure. In this briefing, we'll connect policy to products and markets, so you can see where stablecoins and tokenized assets may create strategic advantage. We'll start with the regulatory landscape, then move into specific US frameworks. From there, we'll connect the rules to stablecoin strategy, real-world asset tokenization, global jurisdiction choices, and the executive decisions that follow. Think of the course as a progression from literacy to decisions. We begin with the regulatory landscape, because product choices make little sense until you understand uncertainty around classification, oversight, issuance, custody, and trading. Then we examine US legislative proposals, including Clarity, Genius, and Stable, and ask what each would change. From there, we translate law into strategy, how stablecoins are issued, redeemed, held, distributed, and supported through partnerships. Next, we apply the same lens to tokenized real-world assets, where legal rights, settlement, custody, and market access matter. Finally, we compare global regimes. The through line is simple. Regulation shapes market design, and market design shapes business strategy. Use this course in the way that matches your starting point. If digital asset regulation is new to you, move in order and build the landscape first. If you already know the basics, focus on the modules closest to your role, especially stablecoins, tokenized real-world assets, and jurisdiction strategy. If you are advanced, treat the material as a reference map for comparing regimes and making executive decisions. As you go, capture notes in 3 buckets: regulatory questions, product implications, and partnership or jurisdiction choices. After each module, pause and ask what this changes about your roadmap, risk model, or market entry plan. The core problem is that digital assets often combine functions that older rules treated as separate. A token might look like an investment because buyers expect upside, but also work like a payment tool, a governance credential, or access to a service. Stablecoins can resemble deposits, payment products, or claims on reserves. DeFi protocols can blur exchange, custody, and settlement. Regulators are therefore not just asking, what is this product called? They are asking, which function creates the risk? That category collision is where uncertainty begins. Uncertainty is not only about what a token is, it is also about who gets to supervise the business. A single digital asset company may trigger securities questions for the SEC, commodities oversight from the CFTC, banking or charter issues for the OCC or Federal Reserve, AML duties under Treasury and FinCEN, and state rules for money transmission, payments, and consumer protection. These regimes were designed for different activities, but digital asset models often combine them. That fragmentation means compliance is not one checklist. Executives need to map each product function to each regulator's concern before launch, fundraising, or expansion. In the US, digital asset oversight is rarely controlled by one regulator or one label. The key question is what the business is actually doing. Issuing a token may raise securities questions. Trading can involve market regulation. Custody may implicate banking, trust, or consumer protection rules. Payments and settlement can bring in banking and financial stability concerns. AML and sanctions obligations often sit with Treasury and FinCEN, while state licensing may apply at the same time. The practical mental model is activity-based. Identify the asset, the activity, the customer, and the jurisdiction. Then map which regulators have a credible hook. Classification is not just a legal label. It changes the operating model. If a token is treated like a security, the business may need investor controls, broker-dealer relationships, and securities compliance. If it looks more like a commodity, trading oversight becomes central. Stablecoins raise reserve, redemption, and consumer protection questions. Deposit-like products can trigger banking expectations. Tokenized real-world assets bring custody, ownership, and settlement issues. Strategy starts with classification, then moves quickly to partners, controls, customer limits, and the executive questions that determine whether the product is viable. That is why classification belongs at the beginning of product strategy, not at the end of legal review. Leaders need to know what the token is doing: storing value, representing an investment, tracking a real-world asset, enabling custody, or supporting payments. That answer drives the next layer of decisions: which rules apply, which regulators matter, and which partners are required. A security-like product may need broker-dealer or exchange support. A stablecoin raises reserve and redemption questions. Custody triggers safeguarding obligations. Classification is the bridge between product design and the operating model required to support it. Before a digital asset initiative is viable, leaders need to test three pressure points together. First is issuance. Who creates the asset? What rights are being offered? And what compliance obligations attach at launch? Second is custody. Who controls customer assets, how they are segregated, and what happens if an intermediary fails? Third is secondary markets, where the asset can trade, who can access it, and what restrictions follow the trade. Treat these as a connected system, not separate legal questions. A weakness in any one area can change the classification, the partners you need, and the go-to-market plan. At the executive level, regulatory strategy has to be managed as a risk system, not a legal footnote. A digital asset initiative can look attractive commercially and still fail because one critical area is underdeveloped. Regulatory classification drives what is permitted. Operations determine whether controls actually work. Custody, reserves, liquidity, and counterparties determine whether customers can be protected under stress. Disclosure, sanctions, AML, and consumer protection determine whether the product can survive scrutiny. The practical move is to review these categories before launch, integration, or investment and assign clear owners. If no one owns a risk, the business is already carrying it blindly. Regulatory clarity turns a confusing market into an investable market structure. When rules are vague, every participant is guessing. What license is needed? Who holds customer assets? Who is responsible for disclosures? And how enforcement risk will be handled? As legislation and regulatory guidance mature, roles become easier to define. Issuers, custodians, exchanges, stablecoin providers, and tokenization platforms can each operate within clearer obligations. That does not remove risk, but it makes risk assignable, measurable, and governable. For leaders, the key question is whether a project is being built only for today's ambiguity or for the market structure that is emerging. Before you launch, partner, or invest, convert regulatory uncertainty into structured diligence. Start by identifying the asset classification, the responsible regulator, and whether issuance, custody, trading, and settlement are permitted. Then test each counterparty. What licenses do they hold? What controls protect customers? And what disclosures are required? Finally, translate those answers into business decisions. If the rules are clear, proceed with defined obligations. If they are unclear, adjust scope, add safeguards, or pause. Market structure is useful because it turns legal ambiguity into practical go, no-go, and risk allocation decisions. To wrap up, digital asset strategy starts with 4 disciplines. Know which regulators matter, classify the asset correctly, map the regulated activities around it, and translate uncertainty into concrete risk controls. Before launching, partnering, or investing, ask where obligations arise and what assumptions must prove true. That diligence turns regulatory complexity from a blocker into an executive decision framework.